All right, let's break down the latest earnings report from Helmerich Payne. This was their big Q4 for fiscal 2025, and it's a fascinating one. You've got management on one hand calling it a pivotal historic year, and then you have the market, which reacted, well, let's just say it was swift and absolutely brutal.
So that's the big question, isn't it? A historic year on one side and a total stock collapse on the other. How does that happen? How can a company be celebrating a huge transformation while investors are running for the exits? Well, that's the puzzle we're going to solve right now.
Okay, so let's start with the headline numbers. This is really where the trouble began and where the market got its first big surprise.
So get this. The adjusted number came in, and it was a loss of 1 cent per share. Now, for a company like H&P, at this point in the cycle, maybe breaking even, you could see that, but an actual loss? Yeah, that was definitely not what anyone was expecting.
And that 1 cent loss looks even worse when you see what Wall Street was looking for. The consensus expectation, a profit of about 26 cents. So they didn't just miss, they went from an expected profit to an actual loss. That's a huge swing, a miss of around 27 cents. Just wow.
And you can guess what happened next, right? The market's reaction was instant, and it was ugly. You combine the regular trading day with the pre-market action, and the stock was down a whopping 17%. Investors saw that miss and just slammed the sell button, no hesitation.
But here's the twist in the story. While the bottom line, the earnings, completely fell apart, the top line, revenue, was actually strong. It beat what analysts expected, crossing $1 billion for the third quarter in a row. So this wasn't a case of them not getting enough business, it was a profitability problem. The question is, where did all that money go?
To answer that, you really have to peel back the onion and look inside the company. Because right now, H&P is a tale of two completely different businesses, each pulling in opposite directions.
So on one side, you've got their North America business. This thing is a rock-solid cash cow. It's gaining market share, its margins are the best in the business, it's just firing on all cylinders. But then you look at the other side, international. This is their big, expensive bet on the future. And right now, it's losing money, mostly because of the huge costs of trying to absorb a massive acquisition.
And wow, this chart really tells the whole story, doesn't it? Just look at the direct margin contribution. North America brought in $242 million, and international and offshore, together, they only brought in about $65 million. It's not even close. The US business is literally carrying the weight of the entire company right now.
But here's the thing. Management sees this totally differently. They're saying, hey, don't look at this one bad quarter. They're focused on the long game, on this massive transformation. For them, all this pain in the international segment is just the cost of becoming the biggest land driller on the planet.
So let's get specific about these transformation pains. What are we talking about? Well, first, there are the huge costs of folding in that massive KCA Deutag acquisition. Second, they're spending a ton of money to reactivate 7 big rigs in Saudi Arabia that were sitting idle. And on top of that, you've got a bunch of other one-time charges. These aren't abstract numbers. They are real costs hitting the bottom line hard, right now.
Okay, so that's the problem. The big question is, what are they going to do about it? Well, management laid out a pretty clear 4-step playbook for fiscal 2026 to turn things around. Here it is, their 4-part plan. First up, slash their capital spending way down from what it was in 2025. Step 2, take the cash they're generating and use it to aggressively attack their debt. 3, get those Saudi rigs up and running perfectly so they start making money instead of costing money. And finally, number 4, find over $50 million in administrative costs to cut. Simple, focused. And that debt paydown piece is a really big deal. That's called deleveraging, just getting debt off the books. And they've set a very specific target, to completely pay off a $400 million loan by the third quarter of 2026. Doing that makes the whole company financially stronger and gives them a lot more breathing room down the road.
Okay, so that's the story so far. Now it's time for our take, what we call the next call. We're going to look ahead and talk about what really matters from here, the key things to watch, and the biggest risks on the horizon.
The timeline for 2026 is everything here. So for the first half of the year, expect more of the same. Continued pressure on margins because they're still spending money on those rigs. But then, mid-2026, that's the key moment. That's when those rigs are supposed to be up and running, finally making money. After that, look for that big debt payoff in Q3. And by the end of the year, that's the final test.
Do we see that big jump in international profit that management has been promising?
Now, of course, this all sounds great on paper, but it all comes down to execution, and there are some big risks here. What if that KCA Deutag integration isn't so smooth? What if the costs to get those Saudi rigs running get out of control? And what if that margin recovery takes way longer than they think? These are the exact questions that have investors sitting on their hands right now.
So where do we land on this? For the next quarter, Q1, we're forecasting another small loss. The costs are still there. Because of that, we think the stock is going to be stuck in a holding pattern, just trading sideways for a while. It's not going anywhere until the market sees cold, hard proof that the international plan is working, probably around mid-2026. That's why we're giving it a market perform rating. The long-term story is interesting, but the short-term risk is just too high to ignore.
When you boil it all down, it really comes to this one simple question. Is the short-term pain we're seeing right now worth the long-term prize of becoming a true global powerhouse? The market is voting no, but management is betting everything that the answer is yes. And how that plays out is going to be the story for H&P over the next year.
And a quick reminder, of course, this is not financial advice.